Lenders behaving badly? Maybe not yet, but cracks are certainly starting to show. From consumer fintech credit to private lending giants and regional bank frauds, risk is migrating into the shadows. It's time to watch credit data as closely as you watch your stocks. Last night, I was in great company, industry colleagues and Bloomberg's top economists, and it didn't take too long for me to find a fellow bullish economist. We talked productivity gains from AI, the massive AI capex spend that can't really last forever, the resilient consumer, easing monetary policy, stimulative fiscal policy, and of course, the wealth effect. I've written about all those drivers lately, and the prognosis for solid growth runs straight through 2026. But what happens after that? I'm going to tell you this. I don't want to waste any good ink guessing about 2027. So let's just be happy with what we have right now and what we know. 2025 and 2026 look pretty good. Long before I solved my first net present value equation, I studied economics. I drew ISLM curves and I messed around with multipliers before I even understood discount rates. I still call myself an applied economist because what I do every day is basically applied economics. Look, Harry Truman once said this: give me a one-handed economist, because they always say on the one hand and then on the other hand. Well, if you follow me long enough, you know I've got both hands pretty busy. I give you both sides because there's always another hand to watch. So as we sat around last night talking about bullish macro themes, we got to that other hand, and that hand was pointing to credit. Let's talk about credit health. Consumers love debt. It's how they stretch their lifestyles, how they turn paychecks into experiences, and how they drive GDP. Consumer credit has exploded by more than 2,000% over the past 50 years in the US. Even in the last 10, it's up almost 50%. The trajectory is pretty clear, and it's up, and it's to the right. But here's the twist. That chart, you've seen it probably about 100 times, the one that tracks consumer credit, doesn't even capture everything. That's because consumer lending isn't just banks and credit cards anymore. Fintech companies like Klarna and others are operating in what the Fed politely calls non-bank financial intermediation. Basically, they lend money without being banks. Buy now, pay later plans, short-term loans, microfinancing and apps, it's all credit, just hidden from the light. And the Fed doesn't even know how much of it exists. We don't know the quality of what that credit is. We don't know the loss rates. We don't know how it even holds up if unemployment rises. That's what keeps economists like me up at night. And that's just the consumer side. Let's shift for a second to the institutional lending side. Bank lending, the traditional kind, is heavily regulated. We know the capital ratios, we know the disclosures, and we know the risks. But banks aren't the only game in town anymore. You see, private credit lending has exploded. Trillions of dollars have flown into private credit funds run by names you know: Apollo, Ares, Blackstone, KKR, and pretty much the rest of Mount Olympus, lol. They lend where banks won't, to companies that are too small, too risky, or too messy for traditional underwriting. It sounds like capitalism working efficiently, capital flowing to productive uses, but underneath that polished surface is a much softer underbelly of risk. You see, unlike banks, these private credit firms don't take deposits. They don't have FDIC insurance, and they don't operate under the same capital requirements. Their loans are negotiated privately, priced quietly, and marked internally. And in a bull market, everything looks great. Returns look great, defaults are low, investors think they found some secret source of uncorrelated returns. But when liquidity tightens, when the economy slows, those structures can creak. Sometimes they snap. Just look at Tricolor Holdings, a used car lender that specialized in borrowers with limited credit histories. It was once celebrated as a social finance success story. It defaulted on nearly $1 billion of asset-backed securities, and that was earlier this month. Then came First Brands Group, the maker of Fram filters and Prestone antifreeze. A real company with cash flows, with brands you know, and yet it breached its loan covenants and sent lenders scrambling. These aren't fly-by-night operations. These are mainstream companies with private credit lenders. Two defaults, though, don't make a crisis, but they do tell a story. They tell us that risk is shifting. It's shifting out of the banks and into the shadows. When too much capital chases too few deals, well, underwriting standards kind of slip a little bit. Documentation gets a little lighter and due diligence gets rushed. The structures look solid until they're tested, and that's when they crumble. Meanwhile, back in traditional banking, the news isn't too great either. Zions Bank and Western Alliance both announced yesterday that they were hit by fraudulent loans linked to distressed real estate funds. Zions took a $50 million charge. Western Alliance fell under similar scrutiny. Those stocks, guess what? They dropped in the double digits in one day. And this isn't happening in a vacuum. These fraud disclosures are arriving just as private lending defaults are hitting the headlines. When stories like that cluster, well, markets tend to notice. Big banks can absorb these kinds of losses, but regionals, well, they feel every dollar. Higher deposit costs, thinner margins, and now fraud-related losses, well, that cuts right to the bone here. There are no signs of imminent collapse or anything like that, but the consumer remains resilient. Employment, thankfully, is still strong. Capital markets are functional, and there is liquidity in the system. But risk is migrating out of the banks and into private structures, out of the light and into the shadows. It's kind of like a frog in boiling water. The heat rises so slowly that you don't notice until, well, it's too late to jump out. Credit is the connective tissue of the economy. And when credit contracts, everything else tightens up with it. Consumption, investment, hiring, all of it. If consumers can't borrow, well, they stop buying. If companies can't borrow, well, they stop building. If investors stop trusting, well, the whole system simply slams on the brakes. So yes, I remain cautiously positive. The macro setup still looks pretty good. Disinflation, AI-driven productivity, CapEx momentum, and a Fed that seems poised to ease. But under that optimism lies that other hand that Truman warned about. You know, the one worried about credit quality, over-leverage, and human nature's talent for forgetting pain faster than we really should. So I'm still bullish, but I'm also still a multi-handed economist. And one of those hands right now is gripping pretty firmly on credit data. In fact, a little tighter than usual. Lenders behaving badly? Maybe not yet, but I'd keep an eye on those hands. So your truth bomb for today is this. When credit flows faulty, growth follows its fault lines. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out. Thanks for checking in with Wall Street Truth Bombs. Remember, we drop them here before the market figures them out.